Okay, great. Thank you very much. Everybody that stayed till this last panel, I appreciate this very much. We usually save the best for last. And we have the distinguished guests flying from DC and California, all the way there. So we try to, engage with this subject that is very dear to me. And when Camco decided to offer alternatives and offer growth private equity, I was very lucky that I was honored by being given a chance to build a product. And we're very happy with the product we built. Our first fund, the Jedi Fund, Fund 1, it was a $45 million fund, which we deployed in less than 4 years. We deployed it very carefully and prudently. And today it's sitting at a healthy NAV. We're up 38%, and we're very happy with that. We're looking for much more, but this is only our 4th year, which I think puts us in a very good position and makes us very comfortable and encourages us to do more. Now, we did this with the help of emerging managers, and that was our strategy. For us to be able to find the best companies that are scaling and to ride that breakout, we had to invest in emerging managers who are doing their first fund or second fund, and they are directly in touch with the founders. And once we have all that data, then we would like to look at the data and find the companies that fit our investment thesis best and double down and triple down. And that's what we did. And that's why today in the Jedi, we have a material position in Mercury, one of the most successful banks, in MaintainX, one of the most successful SaaS companies and maintenance software companies, and several others. And these companies were sourced by the individuals with us on the panel. And so we asked them to come all the way here to share their insights on how we work together, what's the future, what's going on with AI, and with all the noise and all the issues going on and all the billions and trillions being poured in AI, what does that mean for us? And is AI going to be something that's going to help us in our investments, or is it going to cannibalize some of our investments? I mean, we hear a lot about all the things and all the analysts and all the smart financial officers everywhere, and then we hear about AI agents are going to take over their jobs. So it means everyone here is going to be fired, or I don't know what's going on, but we will help. We will have them help us get to that. So how about a quick introduction, okay? And I want this to be a discussion okay, so I'm going to start with yourself. Yeah. Let us know about yourself and Arab Angels.
Absolutely. First of all, thank you for the opportunity to be here today. Thank you to Camco and Burgan Bank. And Fahd, you've been a phenomenal partner, frankly, since the early days of our firm as a personal LP in our first fund in 2017, and then through Jedi in our fund 2. So really, really appreciate the support and excited to be here in Kuwait today. So a bit about myself. I started the firm in 2016. Today we manage about 250 million in AUM across 4 strategies. 2 funds are direct vehicles. One is a fund of funds, similar to the Jedi strategy, and the latest fund that we are deploying out of is a $55 million fund anchored by Mubadala Capital, where we put 20% of the capital to work in other managers, such as my colleagues Patrick and Jake here, and then 80% in early stage companies at pre-seed, seed, and Series A, focused on the US and predominantly sector agnostic. So I'm based in DC, but I spend considerable amount of times in the GCC, given that our LP partners are from the region.
Great, thanks. Patrick?
Hello, everyone. My name is Patrick Yang. Run a fund in San Francisco called Amity Ventures. We are the only, I guess I'm the only one here that doesn't have Camco money yet, or Jedi money yet, but we can change that after this. We have about 1.7 billion in assets under management, hopefully trillion soon. And we're on our 3rd set of funds now. 3 of our funds are in top 5%. So.
Jake?
I'm Jake Zeller. I'm the founder of PowerSet. We are an early stage investment firm. We've been grateful to have Fahad and Camco, Sheikh Abdullah as our investors from the beginning. And prior to PowerSet, I was one of the partners at an investment platform called AngelList. We create tools and software and infrastructure for people in venture capital, many tens of billions under management with that now. And we do lots of investments in AI, so excited for the discussion.
Okay, great. With that note, AI, it's exciting. You know, we heard from the other panelists, it's really just, it's like a vacuum. It sucked all the money in private equity and growth private equity and even private credit. And, you know, we see the big names, the Magnificent Seven, they're investing hundreds of billions every year in AI companies. And, you know, when we thought like Amazon is Anthropic and Microsoft is OpenAI and Google is Google, and now they're all reinvesting with each other, confusing the hell out of everybody. You know, so is it sustained growth? Is it overhyped valuations? What is the signal amongst this noise? And I'll start with you, Jake.
Well, I think there's a lot of things that's in that prompt, but what I think the most important thing to focus on is growth. And what we're seeing is absolutely incredible growth rates in AI. And you want to go towards the heat. That's where amazing things happen. So just in our portfolio alone, we've had 2 companies that went from basically zero revenue in 2025 when they were founded to over 100 million in revenues by the end of the year and many billions in valuation. And you know, there's lots of asset classes you can invest in and things that you could do, but I don't see many businesses in other places where they're going from founding to hundreds of millions of revenue in the same year. And there's a number of businesses across AI that are following extremely similar trajectories, and that's why I think it's by far the most interesting thing happening in the world right now and where people should be investing. It's not to say you should disregard other categories and other businesses. I think some of them may be overlooked, but what we're seeing with AI is the most important thing I've seen in my career.
Very good. Patrick, you're from San Francisco. You're all around. I mean, everything is happening all around you. What do you think?
Yeah, I mean, I'm in the bubble of bubbles being in San Francisco. I would say, try to contextualize it a little bit. In every platform shift, there's always an overheating, and we're always going to go through cycles. But if I look at internet bubble, where there weren't really actually business models set, there wasn't actually internet penetration yet. You had 40 to 50x multiples for companies there on a revenue basis. During the ZERP era period, the 2020s-ish, the SaaS companies had about also a 40x multiple. If you look at the AI leaders today, it's a 20 to 25x multiple, and they're growing way faster. Now, we can debate on durability of some of this revenue. We can talk about that later, but I just think it's a powerful shift. I've been the most excited ever to be a venture capitalist in Silicon Valley.
Good. Amon, what do you think?
Yeah, Fahad, I think it's a tale of 2 stories. I think there's a bifurcation in the market. Today, if you were to think of 2025, we just started obviously 2026. 2025 was the year of concentration in VC. I think there was $270 billion that were raised in private markets for venture-backed companies. 25% of that capital went to 5 companies, right? So there's a clear concentration of capital going into a select few companies that, just like Patrick and Jake had given, anecdotally, they are showing the growth, and they're definitely not as valued as hypey as previous cycles. Now, the fear will always be, will valuations far exceed the pace of growth, and will they sort of set the companies up to fail in the sense that they're unable to grow their valuations? But for us to think of this being a systemic problem across the sector, I think this is probably probabilistically very, very low. I think if there are any issues today, it's more idiosyncratic to specific companies. Did a company raise at a valuation that is way over its head and couldn't really deliver from a growth perspective and kept up with its competitors? So overall, I think it's a tale of 2 stories, a lot of capital going into a handful of companies. And on the other hand, other companies that are doing well but are not getting afforded the same opportunities to raise as much capital with this pace and efficiency.
Yeah, I agree with these points. I think AI is definitely, an inflection point in technology that happens every couple of years. First it was the cloud versus premise, e-commerce and the disruptiveness of payments and all that, and of course the connectivity issue from like 20 years ago, putting fiber optics and satellite connections, and people always think it's overspending, and then somehow it becomes fully absorbed, and because of the demand. And I think that's going to happen with AI too. Now, the problems with AI. So as AI delivers on its efficiency and productivity and how it enables us to do much more, it also is disrupting some companies that have been there, especially some of the SaaS companies, right? So software as a service, you used to go to a company that has figured out how to fill a void in a certain vertical. So if you're in a bank, this company will take care of this part of the banking and make it so much better that you're willing to pay a monthly fee. And that's how we calculate revenues, and that's why we love these companies. But today, some of these solutions are being like replicated by an AI agent. And it's affecting some businesses, and there's a lot of talk on SaaS and how is that going to affect SaaS. We have big exposure to SaaS companies. I mean, yes, I'm not an investor in your fund, but we invested in follow-ons in your companies, in your portfolio companies, some of the better ones. And Jake, one of the biggest markups you have in Fund 3.0, which we invested in with Sheikh Abdullah and Sheikh Yusuf and a lot of our early backers, it's at 110x in your books. And how are you looking at this now that there's this, this danger of the AI coming in? And on Deal and others too, not just to pick on Maintain X, but on others too. So what do you think?
Well, I think is a great question. And for the audience here, I think what Fahad's really digging into here is the fact that software stocks are trading at like a 10-year low in terms of multiples. They're really getting crushed right now. And there's a couple reasons why this is happening. One is just they're not growing as fast as they were before. If you look at COVID, it pulled forward a lot of technology growth. So that's one of the reasons. And to that, I say invest in AI because these are growing crazy fast. But with regards to how the AI impacts the SaaS, I think, as you aptly pointed out, the big concern is around how much easier it is for programmers, which is one of the first major applications of AI. If people have heard the term vibe coding, you're able to just tell a computer what you want to build, and then it's able to build it. So you could say, hey, just build me SAP, and then you rip out your ERP. Not exactly, but you tell it what to build, and it could do it really easily. And people are afraid of this for two reasons. Number one, you could have new entrants into the software space. So you had this SaaS business. Now you could have 15 different competitors that are one-person teams that use AI to enhance their operations. It's one of the issues why people are concerned with software stocks. The other reason that people are concerned with software stocks is DIY, do it yourself. So maybe you were paying a software vendor for one thing. Now you could just rip it out. You could use programming agents. You could build it more easily. So these are the things that are happening. And I think these are valid concerns. But the key thing to look at is durability. Are these software companies that you're really going to rip out and where they're going to have 1 million new entrants, or are these ones that are pretty sticky? And for a few good examples, maybe we should look at the Camco Jedi portfolio. Largest investment is Mercury, which is a fintech neobank, probably approaching $1 billion run rate now. I don't know the data, but just from public reporting, they're over 500. This is not something where you're going to wake up and say, oh, I'm just going to code my own bank. Right? That's not a good idea. It's regulated. Another company, a significant investment from the portfolio is Deal, which is global payroll and compliance. There's a lot of complexities involved when you're starting a company. You're not going to say, oh, I'm just going to roll my own compliance. So I think if you choose the right businesses, which Camco has done a very good job doing, you could be fairly insulated. So good job with the selection on a lot of these companies. I think we're in a good place. On that point, I'd also say we hear a lot of people saying Camco, the best investor in the region. And I think that's kind of offensive. I don't see why everyone's comparing you to Khalijis. The team here has done one of the best job, period, building global technology portfolio. And we all get to learn so much. So thank you.
Thanks, Jake. Patrick?
Yeah, maybe on the vibe coding piece, I want to start by saying I'm extremely bullish on vibe coding or just coding agents overall. As a non-technical person, I've been using Claude Code a lot. But at the same time, if you think about like what that means, Facebook was developed over, I think, 2 weeks. Airbnb, Dropbox, I think, were developed over a weekend, at least the MVP was. Vibe coding and MVP, very, very easy. I've been investing in software for a very long time, maintaining it, making sure it's scalable, making sure it's secure, making sure it's persistent, making sure it's low latency. That is not a trivial thing. It may become more trivial over time, but I still think this death of SaaS is largely overrated. Another point I'd say, if you look at global spending on software, it's less than $1 trillion today. If you look at global spending on labor, that's a $30 to $50 trillion market. AI has enabled software companies to go after that spend. If you look at MaintainX, they're re-accelerating along a lot of their new products because they've launched AI products for predictive maintenance, but also they're going after labor spend now. Their market has expanded in orders of magnitude. I don't know what the exact amount is, but I mean, we were talking about this a little bit earlier. They've been fielding a lot of acquisition offers because of that. Probably not going to take one yet, or unless it's a very big number. But I think there's actually a lot of opportunity in both public market software companies and existing and private as well, as long as they learn to adapt to some of the new trends.
Very encouraging. Amar, any idea? Any thoughts here?
Yeah, Fed, I think there's a few sort of points to unpack. You drew the analogy of this AI wave being similar to the cloud wave. I think you're absolutely right. I think we are going to stop talking about AI as its own category probably in the next 24 months, right? Every single software business, every single business will have some sort of AI component, especially that there's been such a democratization of large language models that today you are chasing now the best sort of products being built on top of these LLMs, right? So it's back to being a fight for let the best products win. So if the best products win happen to be completely AI native, great. If it happens to be a software that's AI enabled, great. And for not every single sector is going to be created equal across the board from a disruption perspective. So I think that's important to note. The other thing too, which I think Patrick, you touched on, vibe coding and AI agents enable you to have an MVP of a software very quickly. And typically there's a spike in terms of some of the revenue that you might generate, but then it comes down and tapers off. So the key is how do you maintain the growth of a piece of software that you built using AI that's AI native, and for it to be competitive to incumbents in the space. That's actually very, very difficult. And in my opinion, it's going to be less about technology and more about everything else. The user experience, the customer service, the partnerships you have, all the other non-AI related components that will then differentiate you from what is frankly completely democratized technology. So I'm still very, very bullish on software. I think AI is going to disrupt a lot of parts of software, but there's still going to be boring software that needs to be built that does a significantly better job than simply an AI agent that's trying to replicate it.
I agree, and I think that's why it's important to remain, practical and realistic. That any new technology is going to be disruptive, and then it's going to plateau, as you said, and then we're going to find out exactly how beneficial it is, and what's all the noise and the silly ideas, just like any other innovation. 2026 is supposed to be the year of liquidity. 2026 is supposed to be when SpaceX goes public at $1 trillion. And OpenAI wants to go public at $1 trillion. And then we have Stripe, one of the biggest fintech companies ever, is going to go public, I think, at a couple of $100 billion. Just these three companies, we're talking about like $3 trillion. 3 companies. And what's the effect that's going to have on the public market, and how that's going to be effective on the startup space. What I'm worried about is we talked about disparity. You know, what I'm worried about is that you have these magnificent 7 companies, you know, Meta, Microsoft, Nvidia, Alphabet, Google, you know, Amazon, Apple, and then, you know, another 3 companies come up with which are worth trillions in market cap, and then everyone else is a small company in the billions. Even the billions look like peanuts now. So this disparity, you know, what's going to happen with all this money coming in? Is it going to be 3 companies that own the world, you know, or is this going to be something that's going to encourage further, you know, birth of new startups? What do you think?
Yeah, I think you're going to see more larger, very large companies. I think it's possible that, you know, we'll come back and do a panel in maybe a couple of years' time from now, and OpenAI may be the largest company in the world, and these growth rates are incredible. And if you just zoom out and look at the conversation around AI, it hasn't really happened yet, but a lot of people are talking about labor displacement. And, you know, do we need to give people like a universal basic income if they're out of work? So everything I've seen makes me believe that we're going to go to a world where we're going to have fewer extremely, extremely, extremely large companies. And that's why you should all be invested in the strategy, because this is where the value is being created.
True.
I mean, just commenting on liquidity, I would love to see it, because that would give our LPs more liquidity, and then they in turn will give more venture capitalist liquidity. I also think there's going to be a dispersion effect where these companies, OpenAI, Anthropic, will probably try to beat OpenAI to go public. SpaceX in Texas, like they will mint new millionaires, new billionaires in those markets that become the next angel investors for innovation. If you looked at it, we've had this concentration of capital in like larger and larger market cap companies. You know, 2 years ago, 3 years ago, there weren't trillion-dollar companies. Now there are several. Apple became the first, and then it was just a laundry list now, and there will probably be more. The long tail, the SMB side of the market has actually grown in that same time. There are more small businesses than ever. Hopefully some of them become large businesses as well, but I wouldn't be too worried about innovation.
To add on Patrick's point real quick, you have millionaires and centimillionaires and billionaires that are being minted in the Bay Area. So Bay Area real estate, despite all the problems with California, might be a very good investment. And to his point as well, you have more angel investors coming in. Part of our strategy at PowerSet is founders backing founders. And we think that founders make for great investors. And this is something that people do when they have capital. And with a lot of liquidity, it's actually going to make it even harder to have access to the best Bay Area opportunities, because founders want the people with operational expertise who've done it before. It's going to be the OpenAI alums backing the next generation of OpenAI people, and that's part of why I think Camco is really well positioned. A lot of people here don't know the backstory, but Fahad and Sheikh Abdullah and team, you know, invested in my first fund when I still had a ponytail. So that's, you know, some adventurous investing, but over 10 years, you have a great relationship, and that's why they're so well respected in Silicon Valley. Many years of patience and perseverance building the portfolio and the network that could thrive in an environment when you have all these newly minted people investing.
Again, very encouraging, because, you know, if we look at Elon Musk and Reid Hoffman and David Sachs and all those big guys that set up companies, they all used to work at a small startup called PayPal, right? And now they're called the PayPal Mafia. And then because they went and set up all these, you know, companies, including SpaceX, Tesla, and, you know, Elon Musk gets a lot of the attention, but, you know, LinkedIn and many other companies came out, Affirm, many other companies came out of that group. So I'm hoping same thing might happen now, you know, with the OpenAI Mafia and the Stripe Mafia and the SpaceX Mafia, and we'll have more of this self-perpetuating positive network effect that people just continue to invest in startups, utilizing AI to, you know, expedite development.
Yeah.
Now,
Fahad, on just one very quick comment before we move on liquidity. You might have heard this, but illiquidity in venture is a feature, not a bug. And you obviously need the right GP-LP alignment for folks to understand that the goal of what we do is to get our LPs into generational businesses. And generational businesses, just as the name suggests, take a very, very long time for them to generate and ultimately produce the liquidity that we're all looking for. In the past, it used to be 7 to 8 years. Now we're looking at 10 to 12 plus years. So this year, liquidity is going to be selective. I think for the first time in 2025, the total value of secondaries far exceeded the value of traditional IPOs. And this is because of the usual suspects, the OpenAIs and Anthropics and the SpaceXs of the world, having an extremely vibrant and liquid secondary market where they frankly never needed to access the public markets and frankly be under public scrutiny, right? So, and sometimes, I had a conversation with a mentor of mine the other day, and he said the last few companies that he IPO'd out of his portfolio, the public market was brutal to the valuation. Does that mean that private market investors are not very smart about how they price companies? Sometimes. But the reality is that there's been a completely separate parallel market to traditional public markets where private market investors are playing in and where they're running auctions. You can't short private companies, right? So I think again, there's another bifurcation in the way the capital markets are being played. And for the first time, there's so much value to unlock in private markets. Some of these companies just want to remain private and use the secondary liquidity mechanisms for consistent liquidity for shareholders.
And keeping employees happy.
And keeping
It's a very good point. Companies decide to stay private longer so they can, not, adhere to public equity, fundamentals, and because there's a risk there of being short, and here you can just be private and hide your financials.
But also for a public, and I used to run investor relations for a publicly traded company back in my old days, and public market CEOs are very quarterly focused. Am I going to make my quarterly numbers? Am I going to beat EPS estimates? That is the antithesis of how you build a generational business. When you build a generational business, you don't really care about quarterly issues. You're talking 7 to 10 year timelines. So by design, some companies should just not really be public. And it's going to be very, very interesting to see once the Anthropics and OpenAI specifically, put aside SpaceX, it's a bit of a different business, on whether these type of businesses and others like them should in fact be under the public scrutiny and be under the sort of the 3-month timelines of quarterly reporting, and whether that's the right way to assess how well they're doing. Yeah.
That's right. So I think, let's say 2026 happens and everything is predicted happens in 2026. All these public offerings happen and they're oversubscribed. There's a lot of, they want to raise like 50 and 60 and 100 billion. We're talking about, just these 3 companies are going to have 300-400 billion cash back into the ecosystem. What would you predict is going to happen? Like, where should we concentrate? Like in your next fund, like you're all having a new fund now. You're, almost done fundraising. So where are you going to deploy? Where do you think is going to be? How there's a vibe coding wave that happened last year, and there's, like, what do you think is next? What's attractive?
Well, if I knew I might incubate or build the company myself rather than invest in it. But if you look at our portfolio, we've been consistently pretty early backing things before they become trends. And usually what we do is we just try and find the brilliant entrepreneurs. So it wasn't our idea. Someone came to us, we assessed their credibility. We're early investors in Lovable, way before anyone, heard of it, or the term vibe coding was even around, and they went from basically 0 to 200 million in revenue in the first year. But we didn't have a thesis that we were going to back a vibe coding company. We just saw that the ingredients were coming out where this is going to be something that could be done. I think, though, what we're going to see is companies may follow a similar shape, and the dialogue now is very clearly around AI. So I expect we'll be deploying a lot of capital there and behind new and interesting themes. It's still very, very early innings in terms of AI adoption and what we're going to be able to do.
Any specific trends or anything you think is you do to look for, or is it?
I mean, I'll give you some,
yeah.
But I generally agree. Like, our way of investing is very similar. Find the smartest people and have them teach us what to pay attention to. And often in many of these cycles, if you look back, some of the biggest companies of that cycle, it could have been during crypto, and I'm pretty sure during crypto it was like Perplexity and a few of these other companies came out from that time. It's often not the big trend of the year that is represented by the biggest companies built at that time. So having some idiosyncratic like thinking and business models or whatnot might be the thing, but if I had to answer, I mean, I do think AI is early. I think robotics hasn't had its like full moment, although a lot of these humanoid robotics companies and I guess the foundational model companies have been getting huge valuations so far. But still think we're really, really early there too.
I could give you a quick story. I assume most people here have ChatGPT on their phone. The technology that makes ChatGPT possible came out of Google. There's a paper called "Attention is All You Need." And this basically invented modern AI. And I know the last author on the paper pretty well, Ilya Politsukhin. And he's the last author, so he was the manager of the machine learning group. And I met him shortly after he authored this paper, which clearly, changed the world. And he was so convinced as to what this was going to do that he went and started a crypto company. He wasn't even working on AI. So it goes to show you that sometimes it can be hard to predict. Even the smartest people who created the technology can't tell you exactly where it's going next.
That's very interesting. I'm going to get to that in a bit. Ahmad, any idea like what might be the trend?
So we just closed the fund last October. So we have fresh capital to invest this year and next year in a new sort of portfolio of early stage companies. And if you look at AAF's track record, I think we've had the most success in fintech. So I caught the fintech 2.0 wave. We were early investors in a company called Current. They had 5,000 users. Today they have 6 million users. They're the second largest neobank after Chime. We were the first check into Drata that Camco Jedi is exposed to. They're in the SOC 2 compliance space. That's also very enterprise, software focused. So if you were to ask me what we're excited about in the next 24 months, notwithstanding the facetious statement that we're very founder focused, which goes without saying, I think I'm very, very excited at the intersection of fintech, AI, and crypto. So all these three are finally converging, right? If you look at a Venn diagram of traditional finance, crypto, and AI, those three are finally coming together. And we will finally start to have AI native banks that power the agentic economy. Right? And you're seeing every other day, if you're on LinkedIn, some announcement around stablecoins. Visa is adopting stablecoins. Tether now has USAT in the US. Stablecoins are here to stay. We're no longer talking about them as some sort of crypto speculative asset, but something that is now enabling cross-border commerce. The second iteration of this is to add agentic workflows so that you have agent-to-agent interaction when it comes to transactions, agent-to-human interaction, right? So we're going to see a lot in the intersection of AI, fintech, and crypto. The other thing that we're excited about, just because it's a dinosaur industry, is healthcare. I mean, even healthcare 1.0, even building a software that marginally improves automation on electronic patient retrievals or booking appointments in hospitals for patients is exciting. Now add to that the AI sort of lever, and you're going to start seeing 10x more efficiency across healthcare networks, hospitals in the United States, and I think that's an extremely exciting space to be investing in. So those two, but again, we're looking at AI infrastructure, custom AI in a box. We just backed a company called Marut.ai. And the way they pitch their customers is, hey, if you're not AI native and want to start implementing AI in your organization, we're a one-stop shop for doing this, right? So there's going to be a lot of those interesting businesses popping up.
Yeah, I saw that Chamath also is getting into this, redoing legacy software with AI. We're excited about a company that also Patrick introduced us to called Sully, which does exactly what you said, automate hospitals and get rid of the bottleneck at the receptions, etc. And again, we sourced it through Patrick and Jake. We have less than a minute left, so like Faisal Athman before, I'm going to finish with one word that was very the hottest word a couple of years ago, and I don't know what's going on this week, and you told me specifically not to ask about it, so I'm going to ask you, Patrick, about it. What's going on with crypto?
Stable coins are great.
Stablecoins are great. So
Okay, well, crypto is down, well, Bitcoin is down like 50% or something in the past 2 weeks or 3 weeks, while gold has shot up to 100%. What's going on with crypto?
Gold technically had a little correction as well.
So Fahad, I can tell you, so my wife runs the prop book for Galaxy, Mike Novogratz.
Novogratz?
Galaxy is sort of the Goldman Sachs of crypto. And she tells me the reason why, let's talk about precious metals for a second before we jump into crypto. The reason why we're starting to see gold and silver behave like crypto is because a lot of where crypto traders trade, now these exchanges and platforms are offering them to buy silver and gold. So they're now levering up on these precious metals in a way that no one else used to do. And that's why you're seeing 3 standard deviations in volatility in these precious metals that you've never seen before. So when that happens, liquidity gets taken out of crypto and rotates into other assets. And the problem with crypto, the problem with Bitcoin is still one of the only sort of cryptocurrencies where very idiosyncratic risks around it. For example, you wake up, there's a whale in Asia that dumped 3 billion. Why? Because his cost basis is $1. And he finally woke up one day and said, you know what, I'm up 100,000% on my investment, time to offload. And the moment someone like that offloads in the market, you see massive volatility. And for the first time as well, you're seeing a decoupling between crypto, between precious metals, and between equities. Again, another very, very interesting phenomenon. So again, it's buckle up is the way to think about it, but also it presents an opportunity to use crypto as a hedge against other more traditional asset classes. So,
Well, I mean, you know, Bitcoin was supposed to be the value asset class that offsets our dependency on gold or whatever commodity once there's a problem in the market. And now there's all these geopolitical issues, and, you know, there's Europe and other places are going sideways somehow, and public markets are scared. Everyone's going to gold, and everyone is dumping Bitcoin, and Bitcoin is down 40, 50%. Whether there's a whale or not, this is a phenomenon. I'm not picking on crypto. I just want to explain to people, what do you think, as major crypto investors, is going on? So, Jake.
How much crypto do you have in your portfolio?
0.
Yeah. Well, you had some before because we made one crypto investment and it was like a 30x realized in 2
Right.
years.
We did BitCloud.
So you had a little bit of exposure, but none now. Look, it's just cyclical. Like I'm not going to pitch people on Bitcoin, but I've been involved in the space for a while. We don't really do it much from our funds. Usually it's like 1% of our assets are deployed into something crypto related, and it's done well historically. But just look at a Bitcoin price chart. It looks like this. Okay, we're in one of these periods. Move on.
Patrick?
Yeah, it is, to your point, there's just a lot of leverage in that space.
Yep.
A lot of these exchanges are still kind of the Wild West, not fully regulated, and allow for ridiculous amounts of leverage. I can go into a deep dive on what happened on 10/10, but a lot of these are just big liquidation moments.
yep.
I do think if we come back here, we could put a Bitcoin price chart on the screen, and I think the numbers will be surprising to people.
It's still at 70 grand or 80 grand. It's still a phenomenal number if you got in at $10 or $1 or a cent. But I'm just saying the volatility is what we're talking about today. And how does that?
for the
I mean,
faint
if
of
this
heart.
was oil, the economists all over the world will the end of the Gulf, the end of this, the end of that, but it's Bitcoin is down 50%. No one cares.
Yeah.
But it's down 50%. Some of the exchanges that bought at a higher price are bankrupt now, especially on Ethereum. You see, one of them is down 5 billion.
Sure.
So, anyway, on that note, okay, thank you very much, and I appreciate you guys staying.